In today's episode of the Daily Brief, I'll talk about two big stories. I first talk about how RBI would be finally happy with the latest banking data. I then discuss why everyone is so hot for quick commerce. Welcome to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to other news channels. I'm your host, Kashish Kapoor. Today is Friday, 6th of December. You can find us on Spotify, Apple Podcast, or wherever you consume your podcast. The Daily Brief is also available in Hindi. And if you like reading instead of watching or listening, you can sign up for our no spam newsletter for a quick rundown. All the links are in the show notes. So let's begin. Do you remember when the RBI chief sounded the alarm about loans growing faster than deposits? It had everyone, economists, analysts, and the media talking. It's a risky situation for the financial system. But before we dive into why, let's rewind and see how we got there. When COVID hit, it threw everyone into a panic mode. People stopped spending, understandably. But for a country like India, where 60% of our GDP comes from people buying stuff, this was a big deal. It slowed the economy down. So what do economic textbooks suggest in such a situation? To lower the interest rates. When borrowing money becomes cheaper, people might be tempted to take loans and spend more. And guess what? It worked. The economy started showing signs of recovery, helped partially by this and partially by other government measures. But then came inflation worries. Why? Well, with loans being cheaper and people ready to spend again, coupled with global supply chain issues, inflation seemed inevitable. And sure enough, it happened. Now the economics playbook says, all right, time to raise the interest rates. The idea is simple. Make borrowing more expensive so people think twice before taking loans. But reality didn't exactly follow the textbook this time. From May 2022 to February 2023, as interest rates went up, something unexpected happened. People started borrowing more, not less. Sounds bizarre, right? But that's exactly what played out. Loan growth hit levels we hadn't seen in a long time. But deposit growth, it stayed pretty average. This created a gap between the two. Here's the math. By the end of 2022, for every 100 rupees banks collected as deposits, they were lending out 130 rupees. That's not sustainable. If deposits don't keep up pace with loans, banks face liquidity issue and the entire system becomes even more riskier. Why was this such a big deal? This mismatch between loans and deposits wasn't just a minor issue. It was a big warning sign. When banks lend out way more than they hold in deposits, it makes the financial system shaky. Imagine if too many loans went unpaid and a lot of people suddenly wanted to withdraw their savings, it could spell serious trouble for the banks. That said, the situation wasn't as dire as it might sound. The total deposits in the banking system were still significantly higher than total loans outstanding. The problem was more about the growth rates. That is, deposit growth was lagging behind the loan growth temporarily. But the RBI wasn't about to take any chances. They wanted to stay ahead of the curve and prevent things from spiraling out of control if the situation worsened. With interest rates already at their peak, the RBI had to think outside the box to tackle this issue. And that's exactly what they did. So what did they do? They pulled out some tricks from their playbook. First, a gentle push. RBI gave banks a friendly nudge, what they call moral suasion, to focus on growing their deposits. Essentially, they told banks, hey, maybe work a little harder to get people to park their money with you. Second, make loans pricier for banks. They increased the risk weightings for certain loans, like consumer loans and those given to the NBFCs. This made it even more expensive for banks to hold these type of loans because they now had to set aside more assets for them. Third, new safety rules. The RBI also introduced stricter liquidity coverage ratio, that is LCR norms. These rules require banks to keep more liquid assets on hand to cover any sudden cash crunches. And four, reining in risky lending. They flagged retail unsecured loans, gold loans, and microfinance lending as areas of concern, urging banks to be extra cautious. We too have spoken at length on how RBI has been so cautious about gold loans, unsecured consumer lending, and microfinance lending. You can check out our previous episodes for added context. Altogether, these steps contributed to slowing down credit growth. Fast forward to today, and it looks like the RBI strategy is working. Credit growth has started to cool off, and it's now below than deposit growth. The gap that was as wide as 8% last year has now totally disappeared. Interestingly, this slowdown is largely because personal loan growth across banks has taken a big hit. On average, these growth rates have halved compared to what we saw a couple of years ago. Let's break this down. First, consumer durables. This segment is getting hammered, and it's bad news for fintechs and NBFCs that were handing out BNPL loans for items like refrigerators, ACs, and other home appliances. With demand cooling off, these lenders are feeling the squeeze. Second, credit cards. The story here isn't any better. Rejection rates for new credit card applications are climbing, and even those who do get approved are seeing lower credit limits. Why? Because some big players like SBI cards have been hit with rising NPAs, that's non-performing assets. This has made issuers much more cautious about extending credit. And finally, other personal loans. Many of these loans fall into unsecured category, meaning there's no collateral backing them. With NPAs on the rise here too, lenders are pulling back, leaving this segment in a decline as well. Interestingly, amidst all of this, housing loans have stayed steady. This suggests that people are shifting their borrowing priorities, focusing on essentials like buying homes rather than discretionary expenses like consumer goods or leisure. It's a clear signal that caution has taken over the lending space. Now, was this a long overdue adjustment? According to this SBI Capital report, this rebalancing was long time coming. The credit to deposit ratio, that's CD ratio, has been too high for too long, which was putting pressure on the banking system. Historically, there have been episodes of credit and deposit growth divergence persisting for 2 to 4 years. As of November 2024, we were in the 31st month of credit and deposit divergence as per RBI study. And analyzing the past data, the end of divergence cycle was estimated to be around June 25 to October 25. But the cycle to end sooner was not anticipated, and it has caught everyone by surprise. So where does this leave us? If the current trend continues, we're likely to see deposit growth fully outpace loan growth in the near future. This would mean a healthier balance for banks and more stable financial system overall. But what it also means is that interest rates had been kept elevated by the RBI for this very purpose will no more be needed, which means that should this convergence actually sustain, a rate cut by the RBI will definitely be on the cards. Now on to the next story. Why does everyone have a hard-on for quick commerce? Quick commerce started as a last-minute ordering app and now has quickly become more like a mall. I mean, not only will you get chai, biscuit, tomato and free dhania, but also a kurta, a trimmer, a sportswear and whatnot. I mean, the list is endless. If you're watching or reading this, look at how Swiggy in its earning report literally says you can get anything from A to Z under 10 minutes. I wouldn't be surprised if these players are taking away business from companies like Amazon. Just think about this. Almost 10 years back, online quick commerce was non-existent. When 10-minute delivery was first introduced in the market, people had just one question: who the hell needs this? Now, it's hard for most of us to imagine our lives without it. This space is moving at a speed that feels faster than the deliveries themselves. Every day, there's a new headline. One day, a company is piloting a delivery of medicines in under 15 minutes. The next, other is expanding food delivery in 400 cities in 10 minutes. It's not just about groceries anymore. It's also about offering a variety of products, price, and innovation. Take Swiggy, for example. They've made some massive moves. Recently, they introduced Bolt, their 10-minute food delivery service, which already operates in over 400 cities and contributes 5% of their total food delivery orders. That's roughly 85 to 90,000 orders daily delivered in just 10 minutes. We believe that speed is distinctive advantage. When you cut the delivery time from 30 to 40 minutes to 10, it unlocks human emotions and use cases in disproportionate ways, said Rohit Kapoor, CEO of Swiggy's food business. While Zomato scraped its 10-minute delivery experiment last year, by saying it didn't look like it would turn profitable, Zepto has quietly begun piloting its own version of ultra-fast food delivery in selected cities. This brings the question: the whole larger narrative that is going around about people wanting healthier food, is that really the case? How fresh can food really be if it's being delivered in 10 minutes? We don't know. Can this 10-minute food delivery become the next big game changer like quick commerce? We will have to find out. Coming to quick commerce, it's not just about speed anymore. Swiggy's Instamart, for instance, is expanding its focus to offer a wider variety of products, scaling up its dark stores to handle more inventory. While this could mean slightly long delivery times for some orders, after all, larger warehouses with more SKUs can make picking and packing more time intensive, with megapods stocking up to 50,000 items, ensuring every order is ready within minutes becomes a logistical challenge. But Swiggy seems to have anticipated this and is already doing something clever to address it. They're splitting their delivery approach into two categories: 10-minute and 30-minute deliveries. The idea is simple but effective. For essentials and frequently ordered items, Swiggy uses smaller dark stores or pods strategically placed closer to customer clusters, ensuring ultra-fast 10-minute deliveries. Meanwhile, larger orders or less urgent items are fulfilled from larger warehouses, giving the system more flexibility to handle the growing number of products without compromising the efficiency. Zepto, on the other hand, has been steadily increasing its footprint, operating over 350 dark stores across 10 cities and aiming to double that by March 2025. They're not just scaling up, but also diversifying. Zepto recently started piloting the delivery of medicines, joining the likes of Blinkit and Flipkart's Minute. Swiggy too has entered this place recently. Swiggy posted its first ever quarterly earning and it reported consolidated revenue of 3,601 crores in the second quarter of FY24, up 30% year on year. However, its net loss narrowed only marginally to 626 crores, largely due to heavy investments in the quick commerce segment. Compare this with Zomato, which reported 4,799 crores in revenue, up 69% year on year, and managed to post a net profit of 176 crores. Zepto, meanwhile, reported a gross order value of 5,500 crores with an average order value of 515 rupees and an estimated take rate of 23%. The scale of competition is intense. Swiggy has 609 dark stores as of September 2024, with plans to double this number by March next year. Blinkit leads with 791 dark stores and aims to cross 1,000 by the same timeline. Zepto's ambitions are equally aggressive, aiming to grow from its current 350 stores to over 700 in the next year. The race is not just about volume, but also about efficiency and innovation. And then there's the broader narrative. Platforms like Myntra have entered the quick commerce game with M Now, promising 30-minute deliveries for fashion and lifestyle products. Amazon is gearing up to launch its quick commerce service, codenamed Tez, by the end of this year. Meanwhile, Flipkart's Minutes is gaining traction in the grocery and is entering pharmacy segment. Yet, amid all this innovation, there are challenges. A recent JP Morgan survey found that 59% of Kirana stores in Mumbai are struggling to compete with quick commerce platforms due to their inability to match discounts. Adit, the CEO of Zepto, few days back mentioned that they are not killing Kiranas. The regulatory environment is also evolving. CCI, that's Competition Commission of India, might decide not to act on allegations of predatory pricing against quick commerce players, citing a lack of market dominance. Meanwhile, Finance Minister Ms. Nirmala Sitharaman lauded the potential of Indian quick commerce startups, calling them global trailblazers and urging policymakers to ensure fair competition while supporting traditional retail. The question that I have isn't whether it will survive, but how this space will continue to evolve. Now, on to the tidbits for the day. First, India's services PMI dipped slightly to 58.4 in November, marking 41 months of expansion. While hiring hit a 19-year high, input costs surged and selling prices rose sharply, reflecting inflationary pressures amid robust domestic and international demand. Number 2, Vodafone Group will sell its remaining 3% stake in Indus Towers for 2,800 crores to repay debt. This move, part of its global restructuring, cements Bharti Airtel's dominance in the tower company while highlighting Vodafone Idea's financial struggles. Third, Saudi Arabia faces mounting challenges to its oil dominance as OPEC Plus members push for a higher production and US shale competition grows. With $1 trillion in infrastructure projects needing high oil prices, Riyadh faces a dilemma: defend prices or retain market share, potentially reshaping global energy dynamics. And finally, India's banking liquidity surplus reached 1 trillion rupees, boosted by government expenditure. However, upcoming tax outflows and foreign interventions are likely to tighten liquidity, potentially raising borrowing costs in the short term. That's it for today. This was the Daily Brief. I'm your host Kashish and I'll see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.